Three REITs we have not reviewed before on the channel. They're all heading towards their 52-week lows. We're going to look at their historical performance. We're going to jump into their dividend safety, look at the supporting underlying metrics, and as always, we're going to run each one through the valuation model, getting to both our intrinsic value as well as our acceptable buy price, considering our investor margin of safety, and also seeing what Wall Street are forecasting for the price target over the next 12-month period. So we start off with REIT number one. It is a high yielder, as we can see on a forward basis, 8.24%. We have a strong buy from quant analyst, a hold from Wall Street, and a buy signal from Seeking Alpha. As we can see, currently trading right there towards their 52-week lows, and a P to FFO of around 8.1 on a forward basis. Now, over the last year, it is down around -2%, and if you've been a shareholder over the last 10 years, you would be down -22%. Bear in mind, it doesn't include dividends reinvested, though we can see a fairly long-term poor performance. So let's dive in. Is there some strong undervaluation in today's episode? We already get a dividend safety score of 50. It does look to be borderline safe, so we will discuss that. Market cap, just over 3 billion. It is a mid-cap company. Now, we do also note their dividend safety was reaffirmed just a few months ago, so we have the suggestion of a moderate risk to their dividend cut over the next full economic cycle. In terms of key metrics, well, in the last recession, they did in fact cut the dividend during the 07-09 crash. They did, however, have better than average growth of the S&P, -6 versus the S&P's -12. We do also note, however, on a recession return, -75, with the S&P bringing in -55. Dividend growth then, what we notice is they had an increase in March 2024. Remember, this is a high yielder, 8% or more. 3.6%. We typically advise on the channel 4% or more, just to advocate to be in line at a bare minimum with the inflation rate of 4% on average over the last 40 years. Over the last 5 years, however, -5% due to that dividend cut, and we do see on average over the last 20 years at around 3% increase year on year. Not the worst if you do consider that inflation is around 4%, and year on year this dividend is on a forward-looking basis of over 8%. We do also note 2 years of consecutive increases to their dividend. As always then, dividend yield theory, it does indicate a company is undervalued when the current yield sits above the 5-year average. We have a severe undervaluation signal, 8.24 versus 6.93, and on a forward P to AFFO, 8.5 lower than the 5-year rolling, so a double undervaluation signal. Do bear in mind though, on this channel, we never look at any of these models in isolation and will conclude towards the end. We also note the real estate sector P to FFO sitting much higher at 13.8. Now, with other companies, so non-REITs, we do focus on the free cash flow. For REITs, a lot more volatile, so we draw your attention to the adjusted FFO, the funds from operations. Below 90% is what we do want to see for the majority of REITs. It's been below that over the last 10 years. In the 60s over the last 2, expected 2024 at around 70%. Now, adjusted funds from operations, ideally we do want to see increasing over the longer term. What we note is, yes, it has increased over the last 10 years, but a lot of inconsistency. And one thing we would point out, FY24, it is expected to lower down to 489. In terms of growth then, very inconsistent as well on a percentage format. We see some years very strong double-digit growth, 2018, 2021, 2022, but likewise we do see some poor years of adjusted funds from operation per share growth, -64 in 2020. In terms of top line growth, 5 to 10% moderate growth for REITs, and we note pretty much every single year they do hit that at a bare minimum. We do also note 2023 at 7%, trading 12 months around 4%, so it will be interesting to see whether or not they do get that 5 to 10% target for the full year. Numerically speaking then, we can see nearly doubled their top line over the last 10 years. Essentially in COVID, their top line did get hit, but they have recovered nicely since then. And what we would say on shares outstanding, if you watch our reviews of companies, what we typically like to see is when shareholders get rewarded, return that excess cash through those share buybacks. With REITs, we will see the opposite, share dilution over the longer period. This is due to the fact that they do retain a little of that internally generated cash flow as they pay the majority out in dividends. One thing I would, however, say is with EPR properties, they definitely do not dilute your position as quickly as we will see in other REITs, for example, the likes of Realty Income and Vici Properties. ROIC, return on invested capital, we do want to see around 3 to 5% for REITs, 10% or more for other companies. These numbers give us faith that management are able to effectively allocate their capital. Very nice to see for EPR properties. Last few years, in fact, around 5 to 7%. So right there at the upper end of what we want to see for REITs, and even better as we can see in 2023. Operating margin, so what we like to see is very strong operating margin rates for REITs. What we do know is some operational inefficiency as the rates have started to come down. Nonetheless, the last 3 years in the 50s still looks very healthy. Finally, we get to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, showing us the number of years it would take the company to pay off all of their debt net of cash on hand. Blanket rule below 5.5 for REIT. What we do notice, it has straddled around that for the majority of the last 10 years, although we can see the peak in 2020. Nice to note it has come down since then. 2024 expected to be right there around that 5.5, so we can understand why that dividend safety score does sit at borderline safe. The AFFO payout doesn't look that bad at all in the 60s to 70s, but we would ideally like to see this come back lower than the maximum of 5.5. Let's jump into the valuation of EPR. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do deep dives and run through every single model. Today's episode, let's just get straight into the final calculation. It is the average of these two models coming to $54.25. As we can see, both in fact coming to a very similar figure. Current price trading around $41. As always, we use a starting margin of safety level, 10%, very important to understand the reason behind it. We only execute if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for EPR, then the acceptable buy price in today's episode is $49, but we'll keep going to see what MOS level it currently trades at, and we can see in today's episode it isn't quite there yet at a 25%, not too far off, but we would say between 20 to 25% for EPR properties. In terms of Wall Street and their expectation, well, over the next 12 months, they do see 16% upside with a price target of $48. And as we can see then, 20 to 25% MOS, 16% upside. But as always, let us know your thoughts in the comments below as we do go along these REITs today, whether or not you are picking up any of these near their 52-week lows. Now, before we do jump to the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, do click on the pinned comment below. Free instant access. We will draw your attention to this article here, how to find undervalued stocks. A lot of people ask on every single episode, what websites do you use for our data analysis? It is all explained in here with all the links as well, so do check that out if that does interest you. Moving on to the next undervalued REIT near their 52-week low, we do have Apple Hospitality REIT, again one we haven't covered before on the channel. We have a strong buy rating from Seeking Alpha 5, so the maximum highest score obtainable, and we have a double buy from Wall Street and Quant Analyst, so it does look to be interesting. As we can see right there towards their 52-week range low, and we see a yield on a forward basis 6.46%, P to FFO of just above 9, and when we do analyze the performance, well, over the last year it is down around 3%. Over the last 10 years we can in fact see it was trading at around $18, so it has come some way down from that point, and over the last 5 years down around 9%. So let's take another look then, and the dividend safety score 50, borderline safe, market cap 3.6 billion, a mid-cap company. In terms of the reaffirmation, well, as we can see, it's similar to the previous REIT, EPR properties, we do have another moderate risk. In fact, just reaffirmed March the 8th, 2024. Key metrics, well then, in the last recession, they had very strong sales. In fact, 59%, well above the average growth, or we should say negative growth of the S&P. Now this one, whilst it does have a yield of over 6%, we do note they haven't increased in some time, with over the last 5 years a negative 4% and over the last 10 years negative 5%, something just to consider. In terms of looking then at dividend yield theory, what we can see here is a strong sign of undervaluation, 6.46 above the 5-year average of 3.57, and we also note the forward P to FFO 11 slightly lower than the 5-year of 11.8. When we take a look as well, real estate sector does sit high at 13.8. Now, in terms of the adjusted funds from operation payout, we can see this is a hotel REIT, so we actually bring it to around 75%. And we do note, in fact, for 2024, it is expected to be lower at around 71%. So that is a positive sign so far. That does give us some positive faith in that dividend safety. When we take a look at the adjusted funds from operation per share, we don't have the full data, so a little bit more difficult to comment on, but we can see it has come down from the 2016 figure of 151, expected around 135 in 2024. So then we draw your attention to the sales growth, and remember 5 to 10%, looking very solid over the longer term. Again, similar with most REITs, and in fact most companies, 2020 was one of the worst years over the last 10-year period. But we note over the last 3 years, whilst the top line has been decreasing, still looking very solid at 9% in 2023. So numerically speaking, what does the sales look like? Well, we can see again, not double, but nearly double over the longer period, and very similar to EPR. Yes, your position is diluted as a shareholder over the longer term, but still not as rapid as others. So I would say this is a fairly positive sign if this is one you are considering, purely based on that shares outstanding metric. ROIC then, very nice to note the consistency, nearly every single year at 5%, so very strong right there at the upper end of our 3 to 5% target. And when we move on to the margins, what we do see is a lot of consistency, a little bit of a drop from the highs of 21-22, but over the last 2 years at 19%, trailing 12 months also showing 19%, looking like this is one that is having some consistency over the more recent period. We then move on to the net debt to EBITDA. Now again, when we are industry specific for hotel REITs, we do bring it down to 3.5. What we do note, 2023, 2022 below that level, 2024 expected to be pretty much very similar to the previous year. So based on this, it is below 3.5. The essential payout is sitting around 71% expected, below the 75% target. So the dividend does look to be safe. Unless anything changes, we will look at the quarterly reports as well as the annual reports. But for now, that over 6% yield does look to be decent. So let's jump into the valuation model. Don't forget you can grab a copy of this valuation model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio, as well as those on your watch list. Intrinsic value then $17.59. Margin of safety, as always, we start off with that 10% level, and we can see it buy up to $15.83. At 15%, pretty much 5 cents shy, so we would say in today's episode, Apple Hospitality has a 15% MOS level. How about Wall Street and their price target? Well, they see over 20%, in fact 23%, with a price of $18.40, whilst also picking up a yield of over 6%. Bearing in mind, if interest rates do start to cut in the second half of 2024, then we could see this propel even higher. But as always, do your own due diligence and do let us know your thoughts on these two REITs so far. The next REIT that we are taking a look at today is EastGroup Properties. As we can see, a buy rating from Wall Street. However, the two analysts giving it a hold. Again, very similarly towards their 52-week low, with a yield trading 12-month basis, the lowest of today, 3.12%, and the P to FFO of just under 20. When we take a look at the performance over the last year, it is down 5%. However, over the last 10 years, it is up 154%. We do know all-time high sitting at $228 at the back end of 2021. So in terms of dividend safety, we have a safe score, 73, market cap just under 8 billion, a mid-cap company, and we can see it was reaffirmed that a dividend cut for EastGroup Properties is looking to be unlikely. Key metrics from the last recession, well, unfortunately, they didn't increase it. They also didn't cut it. They did, however, maintain it. They had above average growth, pretty much flat, and a near S&P return at negative 53%. Dividend growth, a little bit disappointing last summer at 1.6%, given they did increase it very fast, double digits over the last 5 years. Over the last 20 years, on 5% on average, still looking very solid for a company that offers a yield of around 3%. And we can see they have been increasing those dividends for the last 12 years, whilst paying a dividend for the last 29 without a reduction. So we have our double undervaluation signal, yield sitting higher than the 5-year average, as well as the forward P to FFO lower than the 5-year rolling of 30.6, but we do note it does sit higher than the sector P to FFO of 13.8. In terms of looking at the AFFO payout ratio, what we can in fact see below 75% for the industrials, again being industry specific. It has been straddling a little bit higher and a little bit lower over the longer period. No real red flag indicators, 80% in 2022. 2023 we're expecting around 74%, so pretty much in line with that anticipated 75% baseline. So looking okay so far. In terms of increasing adjusted FFO per share, we do notice that, again, a little bit inconsistent, but positive to note, 2024 expected to increase to 684, continuing that increasing trend. And when we look at it on a percentage-wise, for the large part, very, very strong, as we can see, bar 2021, again, near that pandemic, we do see a lot of REITs performing fairly poorly. Sales growth, what I like to see here is that it is an increasing trend, so that is a very positive sign, especially given the fact that it is within that 5 to 10% for the majority of the last 10 years. Last 2 years looking very positive as well. Numerically speaking then, we can see they have in fact more than doubled their top line, nearly tripled it over the last 10 years. And again, this is the third, and interestingly, from this essential analysis today, all three don't really dilute your position as rapidly as others that we have seen on the channel, so a very positive sign. Also very good to see ROIC consistency. What I love, as always, consistency in a very strong metric, 5% year on year, every single year over the last 10 years, making a very attractive option for potential investors. We also know operational efficiency increasing over the longer term. Always great to see an increasing top line revenue as well as increasing margins. We then move on to the final net debt to EBITDA. Now below 5 for industrials, and what we can see is a decreasing trend, which is a positive sign. A lot of positive metrics and a lot of positive movement over time with East Group Properties today. 4.05 in 2023, expected to go below 4 in 2024, so lots to like about this company. How about the valuation? Always very important. And if you do enjoy this episode today, do smash that like button. Let me know if there are any similar episodes you want us to cover, and always hit that notification bell. So the intrinsic value comes to $181, current price sitting at $162. Again, margin of safety of 10%. We do see, whilst this was one of the better, stronger options in terms of the metrics, it does have a 10% MOS level. In terms of Wall Street and their expectations, well, they see nearly 20% upside, $193 price target. In fact, they see it going higher than our calculated intrinsic value, showing they do believe this is a one to consider for sure in the portfolio if you do like to have some of that REIT exposure. As always though, do let us know your thoughts in the comments below. Are any of these you are looking to add and maybe on the watch list? Or I know a lot of people in this community who do like investing in REITs do prefer to look at the likes of the VNQ, the Vanguard ETF in the real estate, as you do get a lot of these REITs that we covered, or in fact you do get some exposure to them some way or another. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. These are 3 REITs that we covered that we haven't before. If there are any, do let us know your thoughts in the comments below. And as always, we'll see you all on the next one.